Late last year, OpenAI's own chief financial officer said something that should have stopped the room. Asked what her company would do with the money Nvidia was putting in, Sarah Freer admitted a large part of it would go back to Nvidia, spent straight back on Nvidia's chips. Sit with that for a second. The chip maker invests in the customer. The customer spends the money buying the chip maker's chips. And on every balance sheet, the same dollar shows up as growth. This is the question hanging over the biggest boom in modern business. Is the demand for artificial intelligence real? Or is a lot of it the same money going around a very small circle dressed up as demand? Because the last time the tech world ran this exact play, it ended up one of the greatest collapses in the corporate history. And almost nobody saw the bill coming until it landed. More on that in this video. Let's start with the deals themselves, because the scale is hard to believe. In September, Nvidia said it would invest $100 billion into OpenAI, the largest investment the company had ever floated. Around the same time, OpenAI signed a deal with the software giant Oracle to buy $300 billion in computing power over a 5-year period, renting the raw computing muscle to run its AI. It struck a separate cloud deal with a company called CoreWeave worth as much as $22.4 billion. Now watch where the money goes next. To deliver all that computing power, Oracle and CoreWeave have to buy enormous quantities of chips. And the chips they buy are Nvidia's. So the dollars Nvidia puts into OpenAI flow into the cloud companies. And from the cloud companies back to Nvidia. Nvidia doesn't just sell it to CoreWeave. It owns a piece of it. And it has agreed to buy any excess cloud capacity from CoreWeave through 2032. Effectively guaranteeing its own customers' revenue. CoreWeave, in turn, borrowed billions using its Nvidia chips as collateralized with Nvidia chips. Debt raised against Nvidia hardware, spent buying more Nvidia hardware. The same handful of names keep appearing on both sides of the same deals. That's why analysts call it what it looks like, a circle. Here's the part the growth story doesn't advertise. OpenAI CEO Sam Altman has said the company is looking at commitments of about $1.4 trillion over the next 8 years. Trillion with a T in computing and infrastructure. And what is OpenAI earning against all that? Not much by comparison. Its revenue last year came to about $13.07 billion in revenue. Not trillion, billion. A rounding error beside what the company has promised to spend. The gap between these two numbers is the whole story. By its own internal projections, OpenAI was on track to lose about $14 billion in losses for 2026. One analyst put it bluntly. For now, the company burns roughly $1.6 for every dollar it earns. It spends about $1.70 to bring in a dollar. Zoom out, and the math gets worse. The consulting firm Bain estimates the AI industry will need something like $2 trillion in annual revenue by 2030 just to pay for all the infrastructure being built. On current trends, it comes up short by an estimated $800 billion revenue gap. This is not a rounding error. That is whole the size of a large national economy. So the pressure is real, and it's showing. When one investor pushed Altman on how a company that size could commit that much, Altman snapped that if the man wanted out, he'd find him a buyer for his shares. And then the numbers themselves started moving. OpenAI has since told its investors that it now plans to spend closer to around $600 billion by 2030. Less than half the figure it was boasting about months earlier. Even Nvidia's Jensen Huang, the deal's loudest champion, quietly walked it back, saying the investment would not approach $100 billion in the current round and privately questioning whether OpenAI spends with enough discipline. The circle, in other words, is already contracting on its own. And that's before anything actually breaks. Here's why this pattern makes older investors flinch. We have seen it before, almost move for move. In the late 1990s, the companies that made the equipment for internet did the exact same thing Nvidia is doing now. This is called vendor financing. Will the company selling the gear also lend its customer the money to buy the gear? Lucent, the biggest name in telecom equipment, committed $8.1 billion in such financing. Nortel and Cisco did the same, lending billions to young telephone companies so they'd buy more switches and routers. It looked brilliant. Sales soared. And Nvidia today is described in exactly the language Lucent and Nortel once were. The safe, essential picks, and shovels play. The company selling the tools everyone in the gold rush has to buy. Now the part everyone forgets. Here is the mechanism step by step. The equipment makers lent the money. Their customers used it to build far more capacity than the world could actually use. Fiber optic lines that sat almost entirely dark. When the boom cooled in 2001 and cheap credit dried up, those customers couldn't pay their loans. And because the vendors had funded the demand themselves, the demand simply evaporated with them. The failure wasn't that nobody wanted the internet. It was that companies had built more infrastructure than profitable demand could fill. And the vendors were left holding loans that would never be repaid. The results were brutal. Lucent took a single write-off for unpaid customer debt equal to 41% of its annual earnings. Notal stock, which had peaked near $87, collapsed until in 2009. They were valued at 18 cents. For nearly $400 billion in value to essentially nothing. The lesson the market wrote down and then forgot is simple. Growth that a vendor pays for itself is fragile growth. It looks like demand right up until the moment it isn't. As the IMF's chief economist put it, looking at today, it was the internet then, it's AI now. And yet, the honest answer is that the parallel is not perfect and the differences genuinely matter. The companies bankrolling this build-out are not fragile startups. The biggest spenders, Microsoft, Google, Amazon, Meta, are among the most profitable enterprises that have ever existed. And they are largely deploying existing cash flow, not borrowed money. Free cash flow just means the cash a company has left after paying its bills. They have oceans of it. The demand isn't purely theoretical either. Their cloud businesses are growing fast, with real customers paying real bills. As one analyst put it, the demand isn't theoretical. And Nvidia's own numbers are far sturdier than Cisco's ever were. At the dot-com peak, Cisco traded at dizzying multiples on thin cash flow. Nvidia today sits at roughly 35x forward earnings with $16 billion in cash flow, but nothing like the fantasy valuations of 2000. Even a rival, Anthropic's Dario Amodei, has defended these deals, saying he doesn't think there's anything inappropriate about that in principle. And CoreWeave's own chief executive has brushed off the circular financing charge as flat out ridiculous. That we are paying with our own cash defense gets harder to hold on when you count the obligations that don't show up in the headline numbers. Moody's has flagged roughly $662 billion in data center lease commitments that are signed but sit off the books, off balance sheet, meaning out of the debt figures most investors ever look at. And the whole tower leans on a few tenants. If OpenAI stumbles, the shock runs straight down the chain, because as one analysis warns, committed revenue is not collected revenue. Most telling of all, the memory chip makers, the suppliers who would profit most if this demand were bottomless, are quietly limiting capacity expansion despite the apparent insatiable demand. When your own suppliers hedge, there's a signal. Which brings us to the only question that really matters. If the cycle breaks, who actually pays? Not, it turns out, the companies in the middle of it. Follow the money outwards and it runs somewhere unsettling, that is towards you. AI-related private lending has already surpassed 200 billions as of early 2026, with hundreds of billions more expected to pour in. Private lending just means loans made outside the banks and often bundled inside complex structures. And those structures reach ordinary people through the quietest doors. The bond giant PIMCO, whose funds sit in millions of American retirement accounts, holds data center debt. And much of that debt is the kind ordinary investors can't buy directly but end up owning through their retirement funds anyway, without their ever knowing it. In one deal spotlighted by the investor Michael Burry, the same man who famously called the 2008 housing crash, chips were sold into a web of shell companies and insurers, with credit risk ultimately landing on retail annuity holders, the retirees who bought insurance products, never dreaming they were financing GPUs. Burry rejects the idea that this debt is any safer than the dot-com kind. Today's AI borrowing, he argues, belies the idea that today's AI debt issuance is cleaner. This is no longer a niche worry. In a formal letter, a group of US senators warned regulators that if AI money can't be paid back, pensions, mutual funds, and retail investors are also exposed. So let us step back and look at the shape of the whole thing. A small circle of companies invested in each other, book each other's money as growth, and grew fabulously rich at the center. The people at the edge, the retirees, the pension holders, the savers who never chose this bet are the ones quietly wired into the outer ring. History's version of this game ended with the insiders cashed out and everyone else holding the paper. So when the music finally stops on this circle, the ones closest to it will already have been paid. The question is, who's still standing inside it when it does, and whether they ever knew they were in it at all. So what do you think about this whole AI money circle thing? Let us know in the comment section below. If you like this video, like, share, subscribe, as we'll see you soon in the next one. Till then, peace out.